Are you worried about your financial future? Many people are. They see their savings dwindle as inflation rises. They watch as market volatility wipes out their retirement funds. It feels like the ground is constantly shifting beneath our feet. We are promised a comfortable retirement after decades of hard work. However, the reality is far less certain. The cost of living keeps increasing. Our hard-earned money buys less each day. We are told to invest in stocks and bonds for a secure future. But what happens when the market takes a downturn? These traditional investments are not as safe as we are led to believe. We need to find a way to protect our wealth. We need an asset that holds its value in the face of economic turmoil. We need to look beyond the traditional investments that have failed us in the past. National debt is skyrocketing. The United States alone is grappling with a debt exceeding $31 trillion. This unsustainable borrowing creates a ticking time bomb for the global economy. Inflation is another major threat. Prices are rising at an alarming rate, eroding the value of our savings. This hidden tax silently eats away at our purchasing power. These factors create a dangerous cocktail for investors. Traditional investments like stocks and bonds are vulnerable to these economic shocks. They can lose value quickly, leaving investors with significant losses. We need to be smarter about where we put our money. We can't rely on outdated investment strategies. It's time to consider alternatives that can weather economic storms. We need to find investments that preserve our wealth, not erode it. The 2008 financial crisis exposed the fragility of the global financial system. Millions lost their homes, jobs, and savings. Traditional investments plummeted in value. This event served as a stark reminder that diversification is not enough. We need to diversify beyond traditional asset classes. Gold emerged as a safe haven during this crisis. Its price surged as investors sought refuge from the storm. This historical pattern repeats itself time and again. Gold has consistently preserved wealth during times of economic uncertainty. The current economic climate mirrors the conditions that preceded past crises. Ignoring these warning signs could be detrimental to your financial well-being. It's time to learn from history and protect your wealth. Throughout history, gold has been revered as a store of value. Ancient civilizations recognized its worth. They used it as a form of currency and a symbol of wealth. Gold's value is inherent. It is not subject to the whims of governments or central banks. Unlike paper currencies, gold cannot be printed into oblivion. Its supply is finite, ensuring its long-term value. This scarcity makes gold a reliable hedge against inflation. When currencies lose purchasing power, gold tends to hold its own. Gold is a tangible asset. You can hold it in your hand. It provides a sense of security that paper assets cannot match. In an increasingly uncertain world, gold offers peace of mind. It is a haven in a storm.
Inflation is a hidden tax that erodes the value of our savings. When prices rise, our money buys less. This insidious force silently eats away at our purchasing power, making it harder to maintain our standard of living. Current inflation rates are at their highest levels in decades. Everyday goods and services, such as food, gas, and housing, have become increasingly expensive. This puts a strain on household budgets and makes it difficult for people to save for the future. Traditional investments like savings accounts and bonds offer paltry returns that fail to keep pace with inflation. This means that even when you are earning interest, your money is losing purchasing power over time. Inflation is a thief in the night, silently stealing the value of your hard-earned money. It is essential to find investments that can outpace inflation and protect your wealth. Gold, the antidote to uncertainty. In times of economic turmoil, investors turn to safe haven assets. These are investments that tend to hold their value or even appreciate during periods of market volatility. Gold has long been considered the ultimate safe haven asset. Throughout history, gold has maintained its value through countless wars, recessions, and financial crises. Unlike paper currencies, which can be printed into oblivion, gold has a limited supply. This scarcity, combined with its historical significance and universal appeal, makes gold a reliable store of value. During the 2008 financial crisis, for example, gold prices surged as investors sought refuge from the collapsing stock market. This flight to safety is a recurring theme throughout history. When uncertainty grips the market, gold shines. As we face the looming threat of another global economic crisis, gold stands as a beacon of stability. It is a tangible asset with intrinsic value, providing a sense of security in an increasingly uncertain world.
The erosion of value stocks and bonds in peril. Traditional investments, often touted as pillars of a balanced portfolio, face an uphill battle in today's economic climate. Stocks, while offering potential for growth, are inherently volatile. Their value can swing dramatically based on market sentiment, geopolitical events, and company performance, leaving investors vulnerable to significant losses. Bonds, often perceived as safer bets, are not immune to erosion. When inflation rears its head, as it is doing aggressively now, the fixed returns offered by bonds are diminished. The purchasing power of those returns dwindles, leaving investors with yields that fail to keep pace with the rising cost of goods and services. This insidious erosion of value undermines the very purpose of investing to grow wealth over time. Furthermore, the current environment of ultra-low interest rates, while seemingly beneficial for borrowers, has created a precarious situation for bondholders. With yields compressed, the potential for returns is significantly diminished, leaving investors with little room for error. The traditional safety net of bonds is fraying at the edges, demanding a reassessment of their role in a well-structured portfolio. Gold, the unwavering guardian of wealth. In stark contrast to the uncertainties plaguing traditional investments, gold stands as a steadfast guardian of wealth. For millennia, gold has maintained its intrinsic value, impervious to the vagaries of political whims and economic cycles. Civilizations have risen and fallen. Currencies have been debased or rendered worthless, yet gold has endured. This enduring quality stems from gold's unique properties. It is a tangible asset, a finite resource with inherent scarcity. Unlike fiat currencies, which can be printed endlessly at the behest of governments, the supply of gold is limited by geological realities. This inherent scarcity, coupled with its historical significance and universal desirability, underpins gold's enduring value. Throughout history, investors have sought refuge in gold during times of crisis and uncertainty. Whether it was hyperinflation, war, or financial meltdowns, gold has consistently served as a safe haven, preserving wealth and providing a sense of security when other assets faltered. This historical track record speaks volumes about gold's enduring relevance in an ever-changing economic landscape. The stark contrast between gold and traditional investments becomes evident when examining their performance during past economic crises. Let's rewind to the stagflationary period of the 1970s. As inflation soared and the stock market floundered, gold shone brightly. Its price skyrocketed, shielding investors from the ravages of inflation and the erosion of purchasing power. Fast forward to the 2008 financial crisis, triggered by the collapse of the U.S. housing market. As panic gripped global markets and stock prices plummeted, gold once again emerged as a beacon of stability. While traditional investments hemorrhaged value, gold held its ground, providing investors with a much-needed hedge against the financial carnage. These historical examples underscore a fundamental truth. Gold's value tends to shine brightest when traditional investments falter. This negative correlation makes gold an invaluable portfolio diversifier, offering a counterbalance to the inherent volatility of stocks and the inflation vulnerability of bonds. In an increasingly uncertain world, understanding the distinct roles of these assets is paramount.
A confluence of unprecedented economic factors is creating a perfect storm for a dramatic surge in gold prices. Decades of reckless monetary policies, marked by excessive money printing and artificially suppressed interest rates, have inflated asset bubbles and created a debt crisis of epic proportions. The chickens are coming home to roost, and the consequences will be profound. As central banks desperately try to contain the inflationary monster they have unleashed, their tools are proving increasingly ineffective. Raising interest rates may curb inflation, but it also risks triggering a wave of defaults on the mountain of debt accumulated globally. This precarious balancing act cannot continue indefinitely. The writing is on the wall. The global financial system is teetering on the brink, and savvy investors are seeking safe havens to protect their wealth. Gold, with its historical track record as a store of value and a hedge against economic turmoil, stands as the ultimate refuge in this gathering storm. Adding fuel to the fire, central banks around the world are engaged in a gold-buying spree, further tightening the supply-demand dynamics. No longer content with holding the bulk of their reserves in fiat currencies, particularly the increasingly volatile US dollar, central banks are diversifying their holdings into tangible assets like gold. This shift towards gold is not driven by sentimentality, but by a cold, hard assessment of the risks inherent in the current financial system. They recognize that gold, with its inherent scarcity, universal acceptance and enduring value, offers a level of security and stability that fiat currencies simply cannot match. The implications of this central bank gold rush are profound. As demand from these institutional giants continues to grow, it puts upward pressure on gold prices. This trend is unlikely to reverse anytime soon as central banks seek to protect themselves from the fallout of reckless monetary policies and the looming threat of a global financial crisis. Adding further momentum to gold's ascent is the dwindling supply of easily accessible gold reserves. Gold mining, a notoriously challenging and capital-intensive endeavor, is facing declining yields. New discoveries are becoming increasingly rare, and extracting gold from existing mines is becoming more expensive and environmentally challenging. This supply crunch is not a temporary blip, but a long-term trend. As above-ground gold reserves are gradually depleted and the rate of new discoveries fails to keep pace with demand, the scarcity of this precious metal will only intensify, further bolstering its value proposition. This confluence of factors, dwindling supply and soaring demand, creates a potent recipe for higher gold prices. As the world awakens to the realities of a broken financial system and the need for safe haven assets, the scramble for gold will only intensify, pushing its price to levels once considered unimaginable. Given the confluence of factors outlined above, it is not a matter of if but when gold will reach $9,000 per ounce. While this may seem like a bold prediction, it is in fact a conservative estimate based on current trends and historical patterns. The factors driving gold's ascent, reckless monetary policies, central bank gold buying, and dwindling supply, are not temporary anomalies, but long-term trends that are likely to intensify in the coming years. Consider this. During the stagflationary period of the 1970s, gold prices rose by over 2,000%. In the aftermath of the 2008 financial crisis, gold prices more than doubled. Given the magnitude of the economic challenges we face today, a similar or even more dramatic price move is not out of the question. $9,000 gold is not a pipe dream. It is a rational expectation based on the fundamentals. In fact, as the world grapples with the consequences of decades of financial mismanagement and the demand for safe haven assets reaches a fever pitch, gold's price could easily surpass this level. Those who recognize the writing on the wall and act decisively to protect their wealth with gold will be well positioned to weather the coming storm. In these turbulent times, preserving your wealth is paramount. Traditional investment strategies, heavily reliant on stocks and bonds, are no longer sufficient. The rules of the game have changed, and a bold approach is required to safeguard your financial future. This is where gold comes in, not as a fringe asset, but as a cornerstone of your investment portfolio. we recommend allocating at least 50% of your investable assets to gold. Now, I understand this may seem radical, but these are not ordinary times. We are facing a confluence of economic challenges, rampant inflation, a global debt crisis, and a teetering financial system that demand a paradigm shift in how we protect our wealth. Gold is not about chasing quick profits. It's about preserving what you've worked hard to earn. It's about securing your financial future against the erosion of fiat currencies and the inherent volatility of traditional markets. The 50% allocation is not a magic number, but a starting point for a conversation about aligning your portfolio with the realities of the economic landscape. Now, you might be wondering, how do I actually invest in gold? It's simpler than you might think. There are several avenues available to you, each with its own set of advantages and considerations. Let's explore these options to help you make an informed decision. Physical gold. Holding physical gold, whether in the form of coins or bars, offers a tangible sense of security. You have direct ownership and control over your investment. Storage and security become paramount. Consider a reputable vaulting service or a secure home safe. Gold ETFs, gold exchange traded funds or ETFs, provide exposure to the gold price without the need for physical possession. These funds track the price of gold, offering investors a convenient and liquid way to participate in the gold market. Gold mining stocks. Investing in gold mining companies offers a leveraged way to gain exposure to the gold price. However, it's crucial to conduct thorough research on individual companies, as their performance can be influenced by factors beyond the price of gold. Remember, diversification is key. Don't put all your golden eggs in one basket. Consider spreading your investment across different forms of gold to mitigate risk and optimize your portfolio's performance. The allure of gold can sometimes lead to hasty decisions and costly mistakes. Let's shed light on some common pitfalls to help you navigate the gold market wisely. Chasing short-term gains. Gold is a long-term strategic asset, not a get-rich-quick scheme. Avoid the temptation to buy high on hype and sell low on fear. Short-term price fluctuations are inevitable. Focus on gold's enduring value proposition. Falling prey to scams. Be wary of unscrupulous dealers offering deals that seem too good to be true. Stick to reputable sources and established dealers when buying physical gold or investing in ETFs and mining companies. Neglecting storage and security. If you choose to hold physical gold, prioritize its safekeeping. Consider professional vaulting services or invest in a high-quality home safe. Insurance is also crucial to mitigate potential losses. Investing in gold should be a well-informed decision, not a leap of faith. Do your due diligence, ask questions, and seek advice from trusted financial professionals. Gold is not a fad, it's a time-tested store of value that has weathered countless economic storms throughout history. When investing in gold, it's essential to adopt a long-term perspective. Don't be swayed by the daily noise of the market or the headlines that scream about price fluctuations. Remember, you are investing in a tangible asset with inherent scarcity, a hedge against inflation, and a safe haven during times of uncertainty. The value proposition of gold remains strong, even if its price doesn't always reflect that in the short term. Think of gold as a cornerstone of your financial fortress, a source of stability and security in an increasingly unpredictable world. Ride out the short-term fluctuations, stay focused on your long-term goals, and trust in gold's ability to preserve your wealth for generations to come. We've covered a lot of ground, from understanding the economic forces driving the gold market to exploring different investment strategies and avoiding common pitfalls. Now it's time to empower you to take control of your financial future. Gold is not just an investment, it's a strategic tool for navigating an uncertain world. It's about preserving your purchasing power, protecting your wealth from the erosion of fiat currencies, and securing your financial future against the unknown. The decision to invest in gold is a personal one. It's about aligning your financial goals with your values and beliefs. We encourage you to do your research, ask questions, and seek guidance from trusted financial advisors. Take the first step towards securing your financial future with gold.